To another straight up Tuesday tip. I'm 𝗤𝘃𝗀𝗀𝘀, licensed agent with Second City Real Estate. With me as always, Mark Ainley, founder and owner of 𝗣𝘃𝗱𝗰𝗀𝘀. And with us for the first time from my core intention, 𝗦𝘃𝗶𝗵𝗁. We have Mike on the show today. He has underwrote over 90 deals in the last 6 months. So has a great pulse on what's going on in the multifamily space. And we want to ask Mike, what are the four mistakes he's seen people make when they're underwriting multifamily deals? So with that, Mike, why don't you provide a little context and take it away?
Yeah, thanks, you guys. I appreciate being here and being on this time. Like you said, Tom, I have underwritten about 90 deals, close to probably $1 billion worth of assets in the last 6 months. And we really focus on the Southeast when we syndicate our multifamily properties. And what I'm finding is that the big thing is pricing. Right. We have written 9 LOIs on those properties we've underwritten and have gone and gotten to the final round 3 times. And we've lost in the final round for a spread of maybe $300,000 to $500,000. I think people are still overpaying for property, thinking that the market is going to shoot up. And I think that the biggest mistake people are making right now is that they're still just trying to win a deal, so they're overpaying for a deal.
Yep. We definitely see the market, whether it be large syndications, 2 to 4 space, single family flips across the market. I think that what you're saying is relevant. Yeah. So let's start with, some of the expenses that are maybe probably being undershot here. What are some of the ones that you're seeing? Let's start at square one.
Yeah, so I'm seeing people buying properties that are maybe 1970s vintage to 1980s vintage. And what they're doing is they're going in and they're underestimating their capital improvement costs. When you are underwriting, you got to take a shot in the dark. And I would rather be more aggressive in how much capital improvement money, CapEx money I'm going to put into that property up front and have to back it off later than to have to add to it going in. So I might look at a 1980s product and say, hey, I'm going to go in and I'm going to do lighting, I'm going to do floor covering, I'm going to do paint, appliances, kitchen cabinets or painting cabinets, countertops, general things like that to spruce that property up so that I can put a different tenant in there and raise the rent. And I'm estimating probably close to $12,000 for interior CapEx. And then the other side of that is the exterior, right? So I'm going to get on Google Map and I'm going to take a look at that property. I'm going to do a street view. I'm going to do an aerial view, and I'm going to see what the roofs look like. I'm going to see what the siding looks like. Do I have to paint? What about landscaping? What about fences, road work? Restriping of parking lots, things like that. And I think people are underestimating, today, where they're trying to make the numbers work, and you can't make the numbers work. The math will never lie, right? So we've got to be more conservative in our approach right now based on where the market's at.
Yeah, absolutely. So you mentioned the improvements. Let's talk about some of the other, call it hard costs, and where they're moving. Right. So capital expenditure, it's always a guessing game. Obviously, better be conservative. Right now, when you get an OM, you have an insurance cost, you have property taxes, and you're looking at those saying, okay, I'm just going to put in what the broker tells me. But where are you seeing those actual expenses trending?
Yeah. So one of the things that I've noticed happening often is big jumps in property taxes and big jumps in insurance. I might get the financials from a seller that I'm going to put into my underwriting tool to stress test whether or not that property is going to work. And they might be paying $300 to $500 a door right now for insurance costs. Well, I know that going into an area like Dallas or an area, let's just talk about Dallas right now. So I know that market, my insurance costs are going to be somewhere around $750 to $850 a door going in. If I'm in Florida, I'm going to be closer to $1,000 a door, maybe even a little bit higher than that. And I'm seeing people using current owner numbers in their pro forma for year one operations and then moving forward from there. And those numbers aren't going to work in an underwriting scenario. It's the same thing with property taxes. With property taxes, the owner might be paying something a lot less today than what you're going to pay. So, there's formulas that we use that, I said it a minute ago, the math doesn't lie. And if you stick to the model and you stick to the formula, the numbers will pencil out. I think it becomes, hey, what's the cost of capital that you're getting to do a deal? And how do you provide that return? Can you even provide that return for the limited investors, the limited partners, your equity investors on those deals?
Yeah. I mean, all of these things we're talking about today basically means you have a return to give to your partners or not. Like that's really the difference. It's crazy. So, all right, that's awesome for that. What about rent growth? I know that's something that's been a topic and people are being really aggressive on. What are you seeing with that and what people are putting in the numbers?
It's really funny because early last year, so early months last year, we were looking at reports that were coming from CoStar and some of the big brokerage firms that were projecting rents. Let's just talk about Florida for a minute, that were projecting rents that maybe were going to be 25-28% for year end. And they didn't even come close, right? We probably came in around 12 to 15% rent growth. But what was interesting was when I underwrote the last deal we bought in Florida, we underwrote it at 8 to 9% rent growth for year one. And then we scaled down because we saw where the market was headed and how we were going to come off of this big high, and that serious rent growth that everybody was seeing was coming down. Well, I think people are still penciling deals today at a higher rent growth, thinking that, man, this market is growing, it's going to keep growing, and I'm still going to be able to raise rents. Some markets you can be aggressive on the rent, but in most markets today, you have to really back those numbers off. I just had the conversation this morning with my underwriter. I said, hey, I think we should start looking at these deals year one, post-renovation year one, after we come out of renovation and we've raised rents, no rent growth the following year. So let's see if these deals pencil at 0 year one, and then let's be moderate and go to 2% instead of 3 or 4, and then let's scale up to 3% from there. But I don't think we should exceed 3% a year right now.
Yeah. And I think also a lot of people are not, we've talked about some of the bigger CapEx stuff, but some of the day-to-day stuff has gone up too, in addition to what we're talking about here, and offsetting some of those gains, and people aren't accounting for that offset.
Yeah, Mark, just look at the cost of bread and milk and eggs right now. Your cost of goods has gone up. So to do what might have cost you $65 or $100 to do a small kitchen faucet leak or under the cabinet leak might cost you $250 today. So those repair costs have gone up as well.
Yeah, it's one of the things that drives me crazy. Someone will model out a deal, even if they're being, conservative in the rent growth, all right, we're going to do 2%, 3%, whatever. But then the expenses don't grow. It's like, those are going to grow, right? Yeah. Like they might not grow in tandem or at the same ratio, but you have to account for them going up. Your expenses are going to go up over time. If you don't underwrite for that and only underwrite for the good stuff going up, like that's not reality.
Yeah. Well, what's interesting is in my tool, I have a tool that we built like over 20 years that we use for this. One of the metrics that I have in the tool is what are the expense growth going to be? And I used to model it where maybe my expense growth was only 2% and my rent growth might have been 5, 6, 7%. Well, now I'm modeling it more like, 2 to 3% rent growth and 2 to 3% expense growth. So I'm kind of staying flat, so. Hey, there's a big one though. I've got a big one, which is your exit cap rate. If you really want to see the performance of a property, you have to be able to really think about the exit cap rate. And the math that I've currently use is I'll take my going in cap rate, and then I'll say, well, I think it's gonna, we're seeing decompression in cap rates right now. So I think that those cap rates are going to go up over the time I hold the property. So I'm factoring in between 20 and 25 basis points per year decompression on cap rates. So if I'm buying a deal today at a 5 cap or a 4 cap, I'm going to add 100 basis points to that on the exit in 4 years. Just, because that keeps that cost more in line. And if I exceed that, I exceed it. But I want to know that I have that protection in case.
Yeah, that's a great point. So let's take just one step back for our listeners who probably aren't, some of them who aren't super familiar with this terminology, because it can be very confusing. To get the value of a multifamily property, you take the NOI. So what is the property earning, not accounting for debt service? Pretend you just bought it all cash. You divide it by the cap rate. So because that's the denominator, when that cap rate goes lower, so let's say it goes from 0.06 to 0.575, the value is going to increase. Correct. Right? The more compressed, the lower the cap rate, the value of the property goes up in that algebra equation, right? So when Mike's saying he's expanding cap rate, he's going from 5 to 5.25 or whatever the numbers are, making the assumption that the property is going to be worth less. The same property producing the same NOI will be valued less in the future because that cap rate is moving the direction it's getting larger, which is the direction investors do not want it to move.
Right. Yeah, it's an inversion, right? So I always tell people, I say, when the cap goes up, the price goes down. When the cap goes down, the price goes up. So it's just a reversion.
Well, I think you have right now, you have where the cap can go up. The expenses go up, or you might even add value and you add a whole bunch of NOI to the deal. But if cap rates, if the price goes down, then you're almost offsetting all of that add value as cap rates compress.
Yeah, absolutely.
It's a huge difference. Like, just go ahead and model something at a 50 basis different. And this is, people always say in multifamily, I love multifamily because I can control the value of the property. But you can control the NOI. You do not control the cap rate, which is the biggest variable. Yes, you have more control than a residential family. Like, I agree with that. But this concept that you control the value, like, you are at the mercy of that cap rate. And I guess I'll make one other point here. If you are buying and holding this thing for the long term, if you're a never seller, this is less of an issue for you. You don't care as much because you're holding the asset for the long term. Maybe when you go to refi, you get a different number, but you're okay with it. But if you are promising investors a return by year 3, year 5, year whatever it is, this is probably the most important metric, and you have no control over it except to underwrite it appropriately.
Right. So here are 2 major points around that. So a lot of people ask, hey, what is cap rate? What does it do for you? What does it mean? Well, I think the easiest explanation for cap rate is if you went in to buy a property at, say you were buying $1 million property and the cap rate's 6%, and you pay all cash for that property, you're going to make 6% on your money. I mean, that's a simple terminology of cap rate. So when you start to bring leverage into the equation and you go get bank debt and you put less money down and you get bank debt and you're leveraging it, that's where your return starts to grow. And that's why cap rate becomes important in that scenario.
Yep. No, good stuff. All things to be aware of. And I'm assuming, Mike, if people have questions with underwriting, are you comfortable with them reaching out to you?
Yeah, absolutely. I love, you know what, it's one of my big skill sets is underwriting. And, I teach people how to underwrite. So yeah, absolutely. If people want to reach out.
How can they get a hold of you, Mike? Sure, and drop your podcast information as well, too, which is a great value you have for everybody.
Well, first of all, if you hang out on social media, any platform, you'll find me. I'm always dropping tips every day on different things. So Twitter, TikTok, Instagram, Facebook, wherever. you can email me directly at mike@𝗦𝘃𝗲𝘀𝗁, or you can just call me, and my number is 312-600-8007.
Where can they find your podcast, or what's your podcast called?
Yeah, so I do a couple different shows. I do one on Thursday morning called Thursday Morning Live, which is really kind of a Chicago-based show, where I try to have a Chicago entrepreneur on, a restaurant owner, business owner, somebody just to talk about business and being an entrepreneur. On Saturday morning, I do a show called Multifamily Unplugged. That's at 10 o'clock on Saturday morning. And then, hey, can I throw a shameless plug in for our live meetup? That's
Do it.
Yeah, for sure.
every second Thursday of the month at 𝗬𝘃 in the South Loop at 67 East 𝗬𝘃. That starts at 6 o'clock.
Wonderful. All right. If we don't have that on our website, we'll add it.
We'll link to those in the show notes as well. So, Mark, who we doing the Chicago Fact for?
Chicago Fact is for 𝗬𝘃𝗲𝗏𝗵𝘁 out of Ravenswood, who bought a t-shirt. It was way back in June. So hopefully she's still listening to the show here.
Man, if we lost her, that's on us. That's not on Caitlin.
Yeah.
So, all right. So in the last couple, we're recording this at the end of January. A lot of talk about the mayor, and the mayoral race. So I figured we'd do a mayor question for you. So, Mark, you get first shot, and then Mike, you get to go. Chicago's known as the Democrat machine. Who was the last Republican to serve as mayor of Chicago? And your choices are William Thompson, Anton Cermak, Fred Busey, or we've never had a Republican mayor.
Who's answering?
Mark, then you.
I would say Busey.
Okay. Mike, who you want to go with?
Yeah, I got to say, I can't remember ever having a Republican mayor in Chicago.
We did have one before our times, guys, but it is William Thompson.
Really? Thompson was. I mean, I thought back then that was the whole start of the Democratic machine back then. Caitlin, I am sorry.
Big Bill.
Yeah. I mean, he was pretty corrupt. I mean, there's a lot of things about him. I just,
man, you know more than me. I only know this from looking up the fact, but he was heavily, your thought process is correct, because he was heavily tied to Al Capone. He was heavily corrupt, but he was not part of the Democratic machine. He was on the other side there. He's on the right.
If I remember correctly, he was actually mayor for a term or two, lost to somebody, and then came back and was mayor again, I think.
You are absolutely correct. And here's another cool fact while we're going down this rabbit hole. He was super popular. He had when he was dead, there was a lot of mourning. And then after he died, 2 safe deposits were found in his house that had like $20 million or something in them. And everyone was like, all right, F this guy.
That's awesome.
That's funny. Hey, and I'm older than both you guys. And I only remember back as far as Old Man Daly,
Mark's a Chicago history buff. He's good at this.
Yeah, I like all that stuff. So, all right, guys. So it's awesome. Mike, thanks for coming on here. Mike, we'll have you back for a full episode at some point later in the year. Tom, thank you as always. Listeners, I don't know if for people that have just chimed on here in the last 6 months, we had an issue with our iTunes where our first 50 episodes were not on there. So we finally got back into the system, and you could go back and listen to our original first 50 episodes. And if you tag us with something funny we did or silly we did, and early on when we're less experienced, we'll throw your name in for this end of the show raffle that we do for the Chicago Fact. So
there's a lot of it.
Yeah. So if you could tag us on the Facebook page, then we can have some fun with this, or if you want to pinpoint the seconds or whatever. So Mike, thank you again. Tom, thank you as always. Listeners, we'll see you Thursday.
Thanks all.
Thank you.